Open any investing app on your phone, and the experience feels remarkably like a chaotic digital casino. You watch glowing red and green lines fluctuate violently, completely detached from the real world. This chart visualizes a 30-year historical timeline that challenges that exact perception. Down here, a standard bank account yields a nearly flat 1 to 2% return. But up here, the broader stock market historically compounds at 7 to 10% annually. If those green and red lines are entirely random, how do they consistently outpace traditional savings and generate massive wealth over decades? That buy button triggers a transfer of real-world property. You are acquiring a legally binding slice of a heavy, tangible business. The easiest way to understand this is to picture a successful company as a single whole pizza. Here is our circle representing the total value of that business. By slicing that exact same circle into millions of tiny, uniform pieces, the company creates individual shares. Each of those slices holds a fraction of the company's total worth. Gather enough of them, and you start holding a highly meaningful percentage of the entire operation. If a business decides to issue exactly 10 total shares, and you purchase 5 of them, you literally own half of everything that company builds, sells, and profits. So why would founders ever willingly carve up their life's work and hand those slices over to complete strangers? Scaling operations, constructing new factories, and expanding globally requires immense amounts of cash. Imagine a founder named Maya. She has an aggressive plan to open Fresh Kicks, a limited edition sneaker store. She needs $100,000 to get the doors open, but she only has $50,000 saved up. She has 2 choices. Option 1 is taking out a massive loan. That provides the cash, but it straps her new business with heavy, recurring interest payments that drain her monthly profits. Option 2 is equity. Maya divides Fresh Kicks into 10 total shares, pricing them at $10,000 each. She keeps 5 shares to maintain control and offers the remaining 5 to outside investors. An investor writes a check for $10,000 to buy 1 single share. Maya instantly gets the debt-free cash she needs to build her store, and the investor walks away holding 10% ownership of the entire enterprise. Selling stock is the ultimate tool for corporate growth. Founders gladly sacrifice a fraction of their ownership today because the cash they receive allows them to build an empire tomorrow without suffocating under debt. Maya's local sneaker shop uses the exact same mechanical blueprint as the largest multinational tech companies and auto manufacturers on Earth. Historically, trading these fractional shares required incredibly complex physical machinery and in-person brokers to constantly track who owned what at any given second. Today, those transactions happen on modern public exchanges, like the New York Stock Exchange and the NASDAQ. These serve as centralized global marketplaces for buyers and sellers to meet. When a corporation goes public, it legally opens its doors, allowing anyone with a smartphone to buy a slice of its future profits. But once those slices hit the open exchange, you have choices to make. Not all stock offers the exact same rights or carries the same risks. This matrix maps out your 2 primary options. Up here in the top right is common stock. It offers the highest potential for growth and gives you actual voting rights on company decisions. The catch? If the company fails and files for bankruptcy, common stockholders are the absolute last people in line to recover their money. Preferred stock drops in down here. You forfeit your voting rights, but in exchange, the company pays you fixed, guaranteed dividends. And if the business goes under, you jump ahead of the common stockholders in the bankruptcy line. Your strategy dictates your choice. Investors seeking maximum upside buy common, while those who prioritize reliable, steady income build their portfolios with preferred. Because these shares represent real businesses, the risk is incredibly real. Let's look back at Fresh Kicks. Suppose Maya's store struggles to compete with massive online retailers. Over a few years, the total valuation of the business shrinks from $100,000 down to $80,000. This bar chart shows the exact damage to the investor. Because their slice represents 10% of a shrinking pie, their $10,000 initial investment instantly drops to a value of $8,000. Market risk is non-negotiable. Your capital is permanently chained to the real-world success or failure of the company you bought into. The primary defense against a single business failing is diversification. Smart investors never concentrate all their cash into one company. They spread it across dozens or even hundreds of different industries. The second defense is time. The global economy experiences sharp, painful swings. But by measuring your investments in decades rather than days, you can ride out the volatility. A stock's value remains anchored to the output of the actual company. Purchasing these legal slices of tangible businesses allows anyone to harness the collective labor of the global economy and build lasting personal wealth.